Hi ladies and gentlemen, this is Game of Trades, and this is going to be a technical analysis of the S&P 500. So the past couple of weeks of trading have been pretty uneventful from a price action point of view. New traders that started trading during this fall got used to seeing these big price moves that have really just been unprecedented in stock market history. This is absolutely not normal. So when I see some of the comments starting to get frustrated that we're really not going anywhere, you really have to realize that this is the reality of trading. It's absolutely normal to be sandwiched between two resistance and support levels and just go back and forth from these levels and not really go anywhere. We've seen that many times throughout history. I mean, just look at here. We were sandwiched between this level and this level. The price action started to coil up and we had a nice big powerful move right after. And honestly, it's only been since around 2018 from back here, from the Trump rally here, that we really started seeing some bigger volatility. Before that, it was just grinding with extreme low volatility and not big price movements. I mean, look at these multi-week periods of consolidation where the markets really just went absolutely nowhere. So back to 2020, having this period of consolidation here, right? In between periods of high volatility, this means the price is really starting to prepare something bigger. And I really love to see price as a spring. And so when you see a dense consolidation like this, what it's really doing is starting to coil up energy for a big move, either to the downside or to the upside. So now which side will this move go? That's the question I'm going to be addressing in this video. Make sure to like the video. It really makes the effort of making these worthwhile. And subscribe if you enjoy the content. Now what we got yesterday was a backtest of this trend line. We were watching this wedge pattern here with a nice uptrend line. We got the break. We got a move to the 272 level that I mentioned in my last video, where I said this was a very strong support level and that the bulls would want to defend this no matter what. And they did. We got a bounce, and now we've gotten a back test. You can see the wick of the candle here tested this trend line, and so we've been reversing so far from there. So it's not very significant, but it's a check mark for the bears. And I wanted to show you an example of that. We were looking at this wedge throughout November and December and even January on the markets, and we broke it down here in January. Then the markets bounced and it back tested this trend line, and then we reversed. And here I made a video talking about this backtest and how it could potentially lead to downside in the future. So these backtests are a real thing, and they are technically significant on the chart. Now what I really wanted to cover on this video was the MACD. And the MACD, as you know, is a momentum indicator. So it shows us where the momentum, which direction the momentum is going in. Here the momentum was obviously to the downside. We had the MACD going down, and here to the upside. This is something I've covered extensively in my videos. But you can also see that we're currently backtesting the zero line. And so why is this so significant? Because the zero line determines the trend. And so as long as we're below the zero line, we're in a downtrend. And if we start breaking up above the zero line, we're officially in an uptrend. And so I mean, from a technical standpoint, just looking at this consolidation, a bull could consider that this is just a period of consolidation to just break out right after and bounce off of. That is something you could say, but why does that bother me so much? The reason is that we would pop the zero line on the MACD. And that may not seem too dangerous at first, but if you go back in history, every time we came back above the zero line after a period of downtrend, you can see here we had a period of downtrend. Every time we pop back above the zero line here, we have a multi-month rally. And so we can go back further here in 2018. We had a downtrend. The MACD was below the zero line, and then we popped back above it, and then we had a multi-month rally. We can go back further than that. In 2016 here, we had a period of downtrend. Here we were below the zero line for a period. Then we popped back above, and we had a multi-month rally. So going back to 2020, if we have this move up above this 287 level that we marked as the top so far, that would mean that the markets need to be able to sustain a multi-month rally. And that would effectively mean that the markets should, from this level, be able to sustain a regular uptrend for months. Now, do I think we can sustain a regular uptrend for months in the current economic environment? Absolutely not. Now, that's my opinion. I could be completely wrong about the fundamentals, but I sincerely do not think so. And so, if the fundamentals are not good, then the probability says that we should not break this level. We should not be able to pop this zero line and start a real uptrend on the daily chart. Now, the problem with this, and you're quickly going to realize this if you're new to trading, there is no such thing as 100 probability in trading. And to show you this, I'm going to go back to 2008. And so you can see here the last real bear market we had a bull trap here that I've covered extensively on this channel. And on this bull trap, we actually popped above the zero line. So this was a whipsaw signal. This was a big whipsaw signal, and it probably, again, trapped many longs into this who trade based off of this indicator, the zero line. And so I wish I could say if we pop this level, if we pop the zero line, we can absolutely forget about the bearish bias and we can hold long and absolutely be sure that there's going to be a multi-month rally. The problem is that's just not the case, and that's where the subjective side of trading comes in. That's where you have to decide what your personal convictions are on the markets. Do you think the S&P 500 can sustain a multi-month rally? By the way, make sure to comment down below if you think that's the case or not. Now let's go back to 2020. And here I want to discuss a little bit of the price action we've seen in the past couple of days and exactly how it speaks to me in terms of the sentiment I get from the price action. And so we had this correction from back here. From the top, we had a nice little move down all the way to the 272 level. And if you looked at my last video, I discussed this level and I said if you are bullish, there is absolutely no better opportunity to ride out the bull market, because this level coincides perfectly with a bull market trend line. And so if you want to get a good price for the next bull market, this was your chance. And so we did get a small bounce. As you see, we did get a little bounce from that support level, but nothing very significant. And so that's something that's changed in the sentiment of the market. You can see back here we had a correction, and then the bulls bought back up that correction. In a couple days, we had a 5% rally. A 5% rally in a couple days. Here we got down to a very strong support level, and we only had a 2% move up. So the bulls got the absolute best chance they got to buy the dip, and we did not get that big bullish bounce that I would have expected to see had the markets been destined for a longer term uptrend. And to prove my point, you can see right here we had same thing. We had a wedge pattern that broke. We got a small correction, came down to the 272 level, and then a big green bounce here. And same thing goes again here. We had a bigger correction down to the 272 level, and then a big green bounce. And that's keeping in mind that the VIX here, the volatility here was way lower than it is now. So this makes this bounce that we got just even more ridiculous compared to the price action that we've seen in recent history. My guess is that the bears are starting to step in a little bit more strongly now and really trying to defend this short-term downtrend that we just started. We're making lower highs and a lower low. So you can check it out on the hourly chart. It is a shorter-term downtrend. So right now I do still favor the bearish outlook much more. But until we break that 272 level, we can't be entirely confident that the bears are really in control. Until we break that 272 level and start seeing more downside, that would put in another lower low and really put the bears in control. So right now I'm really just on the watch out for a nice trade setup with this imminent bearish crossover and this big level to break down. And I mean, same thing goes for the upside. If we start breaking above the 287 level, that would confirm that we're still in an uptrend. That would put on a higher high. That would make us cross above the zero line. That would also break the 50-day moving average. So all of this would be check marks for the bulls. So you can definitely trade this out if you get a break above 287. The 294 level is your first target, and then the 3000 is your next target. So this is really where things are going to happen. This consolidation range is really coiling up for something big, and the ones that are prepared are likely to make a lot of profit from it. Now that's about all I wanted to cover in this video. I hope you guys enjoyed. If you did, make sure to drop a like and subscribe if you haven't already. Make sure to turn on your notifications to get the updates as fast as possible on the markets. Have a great weekend, and in the meantime, good luck on your trading.